Gold has made new all-time highs versus November last year. So let's have a look at some details. For the last few weeks, I've been mentioning that there was probably only about 40% chance that the previous intermediate cycle finished over here at the very middle of December. But clearly with new highs, that has been kind of wrong. It seems to me that the previous intermediate cycle did indeed finish over here in the middle of December. And I didn't actually expect that low to be the significant intermediate cycle low. One of the reasons for that is that makes this intermediate cycle relatively short, lasting for only 51 plus 77 days. That's only 128 days long. That's unusually short. Usually these cycles last for around half a year. Anyway, we are in a new intermediate cycle. So my previous expectations were, let's say, wrong. Let me delete these zigzags. What do I expect now? Well, unfortunately, most of the recent pump in gold has been at least partially due to a lot of risks, a lot of fears on the tensions between Russia and Ukraine. And usually geopolitical tensions don't really create a sustained move up in gold. Yes, they do create spikes, but looking at history, they don't create much of a sustained move. Although in this case, perhaps with the coinciding reason of finally breaking out of this handle of a huge cup and handle formation, perhaps we're going to see something more serious for the pump in gold. But in either case, the ongoing short-term daily cycle has already been going on for around 3 weeks. So what I expect in the short term is perhaps the daily cycle is relatively close to its top, if we haven't topped this morning today already. So perhaps a bit more volatility around these levels, not much more gains from here, before we'll drop into the short-term daily cycle low, perhaps coinciding somewhere with the middle of March, coinciding with that upcoming FOMC meeting, where the Fed is going to raise those rates. Usually, if you look at history, the behavior of gold price is dropping into the expectation of higher rates. And once the hike actually takes place, sell the rumor, buy the fact effect often helps gold to bounce up out of that Fed rate hike. But in this case, we're expecting more rate hikes by the next FOMC meeting in May. So perhaps again, a bit of a new high in gold, nothing extraordinarily significant, perhaps a retest of the previous all-time high that's held for a decade, somewhere around 1925, before we see gold drop into another short-term daily cycle low into the next FOMC meeting in May. But generally for this cycle, I do expect higher lows and higher highs. Let's have a look at the US dollar. As I mentioned in the previous video, that was perhaps over a week ago. We were expecting a bit of a bounce in the US dollar. We see that bounce, but to be honest, I thought this dollar bouncing would bring gold significantly lower into that intermediate cycle low. As I mentioned, that didn't happen. The dollar short-term daily cycle is now 35 days old. So while I don't expect any significant drops in the US dollar in the short term, perhaps a bit of a sideways move into that upcoming short-term daily cycle low. Usually the daily cycles on dollar last for around a couple of months. And as we approach the FOMC meeting and the expected rate hikes, perhaps dollar will bounce a little bit into that rate hike, which sort of agrees with our expectation for gold. A bit of volatility, not far from current levels before dropping down into the short-term daily cycle low around the time of the FOMC. And that would kind of coincide with a bit of a pump in the US dollar based on expected higher rates. Next, let's have a look at our Optimism index in gold. Looking back at the last couple of years, we see that intermediate cycles do sometimes turn out to be pretty long, sometimes they are unusually short, but on average they last for around half a year. And looking at this optics, it's interesting that the intermediate cycles in gold don't always come with actual local lowest levels on the optics. In the last two intermediate cycles, as we see, the optics has made a higher low versus a lower low on price. So sometimes into those intermediate cycle lows, we might see a bit of a positive divergence in optics, while at other times we might actually see local significant lows in this optics. In either case, right now the optics is just below 60, so we still have quite a lot of room to go higher on gold price before the optimism becomes a little bit too excessively optimistic. So as I mentioned, I still expect higher highs and higher lows on gold for perhaps another few months, accompanied with quite a lot of volatility in relation to these FOMC meetings. And talking about volatility, I've mentioned I expected quite a lot of volatility on the general stock markets as well. Again, that's what we are seeing. We see a red candle yesterday on Thursday in S&P 500. In this case, my expectations for the general stock market are still generally where they used to be over the last few weeks. The continued volatility on Thursday, it looks like it's mostly based on renewed warnings from the US on imminent Russian invasion. So the US keeps warning us about the invasion. Russia keeps denying it. We'll see what happens. But as I mentioned in one of my recent videos, I think it's more likely that invasion doesn't take place, at least in the short term, and allows this intermediate cycle to mostly chug along sideways, as I mentioned, with quite a lot of volatility with FOMC meetings as well. Talking about the FOMC meetings, the Fed presidents keep talking of significantly higher rates, so that is also adding to some volatility on the general stock market. So with that in mind, the daily cycle is now 24 days long. And I think perhaps the stock market is kind of running out of time to make any significant push above the 50-day moving average before it might actually come down into that FOMC meeting in mid-March. So what I'm going to do is I'm going to bring down my sell limits and reduce my stock market positions significantly in expectation of that FOMC meeting. For more details on what exactly I'm doing, as well as a look at a range of other assets and a range of other interesting indicators, you are more than welcome to join us at myfinancesteacher.org. And lastly, talking about those indicators, let's have a look at a couple of interesting ones. Here's the Optimism Index on the general stock market. And as we see, it's pretty low. It is just over 30. Of course, there is a scenario, as I mentioned, where the stock market just continues to drop into the intermediate cycle low over the next 3 weeks. But as I mentioned, that's probably a 40% chance scenario with a 60% chance of a more of a sideways move. So with the Optimism Index just above 30, yeah, there is room to drop even further back down to 20 or below. But I think it's more likely that optimism is going to recover with a bit of a sideways move in the general stock market, accompanied with quite a lot of volatility for the ongoing intermediate cycle. And lastly, let's have a look at this interesting metric, the dumb money and smart money confidence. The smart money here is the red line, dumb money is the blue line. Dumb money are the small traders, smart money is the large institutional traders. It's usually a good idea to follow the smart money and avoid mirroring what the dumb money does. As we see over here, smart money is pretty confident right now. So as I mentioned, there is a 60% chance scenario where the stock market recovers just a little bit before coming down into that FOMC meeting. So in summary, the expectations on the stock markets are still the same, with gold expectations changing somewhat given the previous intermediate cycle low in mid-December. But as I always say, nobody actually knows the future, so I do want to know your opinion. Let me know what you think on the general stock market and precious metals down in the comments. I'll try to do my best to address all of the comments. Bye bye.